We start tonight with the big market story, which is the phenomenal gold rally that continues. It was up $12 today. It closed at $1,115. And in the last 11 trading days, gold is up $87 or 8.5%. Now compare that to the S&P 500, which is up roughly 3%. Year to date, gold is up a phenomenal $240, and it appears there is no end in sight. So let's talk gold right at the start. With us is James DeGeorgia, author of The Trader's Great Gold Rush. We have Jeff Kleintop of LPL Financial and Drew Kanaly, chairman of the Kanaly Trust Company. Hello, gentlemen. This is the hottest market story. It has been and continues to be. Let me start with Mr. DeGeorgia. James, welcome to the Kudlow Report. How high, how long?
It's a pleasure.
How high, how long for gold, in your judgment?
Well, first of all, I'd like to say that when you invest in gold and you're looking at gold, you've got to keep in mind that it's the best insurance against the stupidity and power greed of politicians. So what's going on in Washington and has been going on the last 9 years is really stemming this rise. And how long will it go? You know, I predicted at the beginning of the year that we would be at 1,200 by the end of the year. We're approaching that level. My fear is that we'll see $2,500, $2,000 gold within the next 12 to 36 months. And there's an outlier possibility that if they mess things up enough in Congress, in Washington, that we will see a $5,000 spike, and it will be a catastrophe.
All right.
And because they're not following your advice, they should be following your advice. King dollar is what's important, and their eye is off the ball.
I'm still for King dollar, and I liked it when the dollar was high and gold was low. That was pretty much throughout the 1990s, by the way. We saw a lot of that in the 1980s, but that's the way I liked it. Drew Kanaly, let me get your response to what James has just said. He's got a tremendous scenario here. What's your take?
Well, we were buyers of gold early on as we watched Fed policy. We can read a money supply, too, and so we were very concerned about inflation. But if funny things happen on the way to inflation, it's not there. And even more so, bank lending's not there to support inflation theory going forward. Now, further out, we believe it's going to happen. 2, 3 years out, inflation's coming. Gold's just run a long way, really fast. We bought it for that hedge. We're now concerned it's way ahead of itself. In fact, we've taken a profit in gold in here, and of all things, we've bought the dollar.
All right, so you're selling gold and buying the dollar. Let me just follow up on that. Is there a particular event that puts you in that gold short, dollar long position? Because you're running against conventional wisdom, which may be a terrific thing to run against. But was there an event here? Especially, we're going to cover it in the next segment more, but the possibility that Congress wants to politicize Fed independence.
Well, leave that out of it. What we know is the dollar's down 40% over 10 years. And we also know that there's a lot of people out there, and all they're doing is shorting the dollar, Larry. And when you get, conviction at 100%, it really can't go much higher. So we're a bit of a contrarian here because we feel like it's just too big a trade to short the dollar, borrow a bunch of money, and buy any asset you want. It's not just gold. It's every asset class you can think of has rocketed this year under that trade platform. So we think that that's probably going to get unwound.
The dollar has become a carry trade,
Correct.
And that's where you should be focused. You shouldn't be focused on the inflation side. You should be looking at the dimension at which the money supply is growing and how cheap it is to speculate. And you should be paying attention to the emerging markets.
But hold on one second there, because what we've seen is, today the move in gold was not about the dollar. The dollar was flat today.
No, it isn't.
That's not what pushed gold up. What pushed gold up today was the outlook for China, right? Tremendous growth in these emerging markets and an emerging middle-class consumer of gold in China. So I think that's something that we're maybe missing here with the dollar story, but that story is going to fade next year. China is going to begin to pull back on lending growth. India is going to begin to hike interest rates early next year. Those fundamental drivers are going to turn negative for gold and maybe positive for the dollar.
Oh, come on. They're going to be buying for their treasuries. They're buying for their treasuries. They're diversifying their assets. They know that this is a long-term situation with the depreciation of the dollar. They see that our physical house is a wreck. It's getting worse. And, Larry, you're right. The politicization of how we're spending our money and what we're doing to ourselves, we're very much like Britain after the First World War. We were destroying ourselves.
Not to speak of the Second World War. Jeff Kleintop,
Second World War.
Not to speak. Hang on one second, though. Jeff Kleintop, let me go back to your China point. I think it's a very interesting point. There are lots of news reports today that on the eve of President Obama's trip to China, Mr. Obama, I guess, goes to Japan tomorrow. He'll hit China over the weekend. There's going to be an announcement by the Chinese Central Bank, which released their monetary report, Jeff. You probably saw this, and hinted very, very strongly that they're going to unpeg to the dollar, go back to the policy of the couple of years before the financial meltdown when the yuan went up 20%. And effectively, they're going to appreciate their currency, the yuan. All right, now, that means yuan up, dollar down. How does that impact gold in your judgment? Because after all, if the Chinese appreciate their currency, Jeff, as you know, that is a tightening move insofar as Chinese monetary policy is concerned. Could that depress the gold price?
It could, Larry. You're right. And this is something we've got an eye on here, but I think it's too early to expect actual action. They may talk a little bit more about it with Obama, and they've sort of presaged that a little bit. I don't think we're going to see any real action there until the early part of next year, perhaps on the currency in addition to loan growth. So, yes, I think that's coming, and that's some of the indications we've got just here today out of the finance minister.
Incidentally, I agree with you that these reports did suggest it won't happen overnight. It's going to wait until early next year. The Chinese do move rather slowly. Let me go back here. James, let me ask you this. Dick Fisher, who's supposedly an inflation hawk from the Dallas Fed, Dick Fisher. Now, he was on the tape today saying that growth and inflation are below the Fed's targets. And he hinted, as others have, that there aren't going to be no exit strategies from the Fed even next year in 2010, James. I mean, I find that very interesting. Fisher's supposed to be a hawk.
Right.
And if they're not going to exit in 2010, and we're going to wait till 2011, with this balance sheet growing, by the way, the balance sheet is up another $400 billion in the last couple of months. The monetary base is picking up steam. What does that do to your gold call?
I think it supports it. And I would point out, going back to the Chinese, you know, they're going to incrementally increase the value of their currency. It's not going to come all at once, but it's going to give them more buying power, and they have plenty of dollars that are pouring into their treasury. They're going to diversify. They're going to buy large amounts of gold, and you know, what we have is basically a global power shift that's underway. It's coming through the financial markets, and if we're not astute and don't get our fiscal house in order, it's only going to get worse. He's right. The Fed can't do anything to
they could.
Raise interest rates.
You know, Fisher's he's just saying
it'll be a disaster.
It was very similar to what Jeff Lacker of the Richmond Fed told our Maria Bartiromo yesterday. I mean, he wasn't specific, but she asked him about a 2010 interest rate move, and he said he wasn't prepared to go there. Now, that's very interesting.
It's not going to happen.
Let me ask you this. How do you buy gold? What is the best way, since you are a bull, for those investors out there who are a bull, and agree with you, James DeGeorgia, how do you make the play?
There's only two ways that I recommend people buy gold. One's going to be very surprised, but both of them are physical. I like people to put money into IRAs. The government allows you to put physical gold in non-fungible IRA accounts, and also take physical possession. Now, there are some alternatives. There are one or two ETFs that you can buy that are safe, that actually have their gold in a non-fungible and don't have any derivatives. You know, those are fine. But personally, every time I turn on the TV and I see what's going on, or I read a newspaper, what's going on in Washington, I want to physically hold the gold myself. So I buy U.S. Eagles, Buffalo, 1 ounces. I want to take physical possession of it. I feel more secure.
Eagles are trading at a premium to the market. It's very interesting. Drew Kanaly, I want to ask you the very same question. How do you play the gold? When you come back to it, Drew, how are you going to do it?
Yeah, we do it two ways. We own ETFs. We either own the gold miners or we own the gold bullion. And we own it both ways. And one other thought back to the Fed, one that may come as a surprise. You know, at some point they have to get lending going, don't they, Larry?
Yes.
To create jobs,
yes,
right, to get reelected.
It may come sooner than you think. I mean, they're putting the money out there. The money is lying idle right now. The banks are putting the money in
Treasury. So what are you going to do?
Treasury bonds, but they're also in excess reserve. There's $1 trillion of excess reserves sitting in Federal Reserve deposits.
Correct. So what you want to do is you want to eliminate that incentive to just buy the Treasuries. You want them actually to make loans. So you might actually raise rates a little bit to squeeze that and make a loan more attractive to a bank.
All right, so you really are giving me a bear position on gold. That's really what you're saying? Is that what you're trying to say?
3 years out, okay, you want to be an owner of gold. Once the velocity of money takes off, it'll be too late to be guessing about owning gold. So you want to have a gold position now, but you want to be careful about adding too much to it in here.
That's why I think they got to get rid of this free money. Jeff Kleintop,
Correct.
what